The financial bomb everyone said would never detonate just exploded. And if you don't understand what's happening right now in Japan, your portfolio is about to take a hit that could wipe out years of gains. I'm talking about Japan's bond market, and it just had a meltdown that sent shockwaves through every major financial market on Earth. The 30-year Japanese government bond yield spiked to the highest level since these bonds were first introduced back in 1999. Think about that. 26 years of history, and we just hit a record that wasn't supposed to be possible. But here's the part that should terrify you. This isn't some distant problem happening on the other side of the world. Japan holds over $1 trillion in US Treasury securities. They're the largest foreign holder of American debt. And when Japan starts selling, every asset you own, stocks, bonds, real estate, crypto, all of it becomes collateral damage. The US Treasury Secretary is literally on the phone with Japan right now, begging them to calm the markets. Not with actions, not with solutions, just words. When the most powerful finance official in America is reduced to hoping another country says something reassuring, you know we're in serious trouble. So here's what we're going to do in the next few minutes. I'm going to break down exactly what's happening in Japan, why it matters to your money, and what you need to do right now to protect yourself before this spiral accelerates. Because this story is just getting started, and most people have no idea what's coming. Let me paint you a picture of how bad Japan's situation really is. Their debt to GDP ratio sits at over 230%. To put that in perspective, the United States, which isn't exactly a model of fiscal responsibility, has a debt to GDP ratio around 120%. Japan has literally borrowed more than twice their entire economic output. Here's the analogy. If you earned $50,000 a year, Japan's debt situation would be like owing over $115,000. And for 3 decades, they paid virtually zero interest on this mountain of debt. They ran the longest financial experiment in modern history, keeping interest rates at zero or even negative for 30 years straight. Everyone thought this was the new normal. Economists wrote papers about it, central bankers studied it, investors accepted it as just how Japan operates. But that era is over, and it's ending violently. The Bank of Japan raised interest rates in December to 0.75%. I know that sounds pathetically low, and it is, but it's the highest rate Japan has seen since 1995. Think about that date. Most of today's young investors weren't even born the last time Japanese interest rates were this high, and they've completely abandoned their efforts to control interest rates. For years, the Bank of Japan acted like a whale in the bond market, buying up massive amounts of government bonds to suppress yields and keep borrowing costs at zero. They owned over half of all Japanese government bonds at one point. Now they're selling. They've cut their balance sheet by over 60 trillion yen in 2025 alone. When the biggest buyer in any market suddenly becomes a seller, prices collapse. And when bond prices collapse, yields explode. That's exactly what we're seeing. But it gets worse. Japan's new Prime Minister, Sanae Takaichi, is pushing for massive government spending increases. She's calling for tax cuts and stimulus programs, while the country is already drowning in debt. She literally called snap elections to get a mandate to spend even more money. The bond market looked at this proposal and said, absolutely not. Yields went through the roof. The 30-year bond yield spiked nearly 30 basis points in a single session, hitting roughly 3.9% at one point. For bond traders who are used to glacial movements, this was an earthquake. Now you might be thinking, okay, Japan has problems, but I don't own Japanese bonds. I live thousands of miles away. Why should I care? Here's why. Japan owns over $1.2 trillion in US Treasury securities. That's more than Mexico's entire GDP. It's bigger than Apple's market cap. And for the past 30 years, Japanese investors have been funneling money into US debt like it was free money. Because it was. Let me explain the trade that's now unwinding. It's called the carry trade, and it was the closest thing to a free lunch that global markets have ever seen. Here's how it worked. You borrow money in Japan at 0% interest, literally free money. You convert those yen into dollars. You invest in US Treasury bonds that pay 4 to 5%. You pocket the difference. It's pure profit with seemingly no risk. Hedge funds didn't just do this trade, they leveraged it 20 times over. Some estimates put the total size of this carry trade at hundreds of billions of dollars, with some analysts suggesting it could be even larger when you account for all the derivatives and leveraged positions built on top of it. But now, Japanese bond yields are climbing toward 4%. Why would anyone borrow in Japan, deal with currency risk, manage the hedging costs, and send their money to America to earn maybe an extra 0.5% or less? No rational investor would do that. So the carry trade is unwinding. And when I say unwinding, I mean hundreds of billions of dollars of positions are being closed. Japanese investors are selling US Treasuries. They're buying back yen. They're bringing their money home. We've already seen previews of what this looks like. Back in August, when the Bank of Japan made policy moves that strengthened the yen, the Nasdaq dropped 10%. The S&P 500 fell 8%. Bitcoin crashed over 20%. Over $1 trillion in market value was wiped out in days. And that was just a preview. That was the market testing what would happen if the carry trade started to unwind. Now it's not a test anymore. It's happening in real time. Here's what most people don't understand about leverage and forced selling. When hedge funds and institutional investors are leveraged 20 to 1, they don't get to choose what they sell when positions move against them. They get margin calls. They have to sell everything. US stocks, corporate bonds, crypto, commodities, everything hits the market at once. And according to Bank of America, half of the major money managers controlling most of the US market have zero downside protection. They're fully long, fully exposed, and completely unprepared. They're all on the same side of the boat, and the boat is starting to tip. Now let's talk about another problem that nobody's discussing. Europe holds about $8 trillion in US bonds and equities. That's double what China and Japan hold combined. And Europe needs money desperately right now. They need to massively increase defense spending. They need to fund economic stimulus. They need to deal with energy crises and political instability. Where do you think they're going to get that money? They're going to sell US assets. The US Treasury Secretary stood up at the World Economic Forum and told Europe they should spend more on defense. Great advice, except what happens when they fund it by selling US debt? That spikes American interest rates, which chokes the American economy. And his response to this crisis? He told everyone to sit back, take a deep breath, and let things play out. He said he's been in touch with his counterpart in Japan, and he's sure they'll start saying things to calm markets down. Saying things, not doing things, not implementing solutions, just talking. When the Treasury Secretary of the United States is reduced to hoping that Japan finds some reassuring words, that's when you know the adults have left the room and nobody has a plan. Now here's something most investors don't understand, and your financial advisor might not tell you. There's a concept called correlation breakdown. In normal times, when stocks go down, bonds go up. That's the whole point of a balanced portfolio. Your 60-40 stock to bond allocation is supposed to protect you because bonds provide safety when stocks crash. By the way, if this breakdown is helping you connect dots that mainstream media isn't covering, hit that subscribe button. Most people won't see this coming. Make sure you're not one of them. But when a government's creditworthiness comes into question, both stocks and bonds go down together. Your hedge no longer works. It becomes 100% risk on both sides. Ken Griffin, the founder of Citadel, one of the largest hedge funds in the world, warned about this explicitly. He said, when bonds and stocks move together in price, bonds lose what makes them special in a portfolio. Translation, your diversification just evaporated. Michael Hartnett, a top strategist, said, if you want to protect yourself against these kinds of risks, do it with gold. And maybe that's why gold has been exploding to record highs recently. Same with silver and platinum. Precious metals are sending a signal that something is breaking in the financial system. But I'm not here to tell you to panic and dump everything into gold. I'm here to help you understand the frameworks so you can make informed decisions. Because here's the reality. Markets go through cycles. Crises create opportunities. The investors who understand what's happening are the ones who position themselves ahead of the chaos, not the ones who react after their portfolio is already down 30%. So what does this mean for your specific investments? Let's break it down. If you own tech stocks funded by cheap debt, and most of them are, those valuations are built on low interest rates. When borrowing costs spike, growth stocks get crushed because their future cash flows are worth less when you discount them at higher rates. If you own real estate or have a mortgage, even if the Federal Reserve cuts its policy rate, mortgage rates could actually go up. Why? Because the market sets long-term rates, not the government. If bond yields spike because foreign investors are selling, your 30-year mortgage rate moves with that, regardless of what the Fed does. If you own crypto, which is already volatile, forced liquidations from hedge funds unwinding the carry trade will send Bitcoin and everything else off a cliff. It happened in August, it'll happen again, but bigger this time. If you own a diversified portfolio through your 401k or pension fund, you probably own both stocks and bonds. And if those correlate to the downside, you're getting hit from both directions with no protection. The scary part is that most retail investors have no idea this is even happening. They're still thinking about what stock to buy next instead of asking whether they should be in stocks at all right at this moment. Now, let me be clear. I'm not saying sell everything and hide under your bed. I'm saying understand the environment you're investing in. The rules just changed. The era of free money from Japan propping up global asset prices is over. So here's what you can actually do right now. Start watching the 10-year US Treasury yield like a hawk. If that thing breaks above 4.5% and stays there, that's not just a number on a screen. That's a danger signal screaming that foreign selling has gone into overdrive. Next, be brutally honest about your portfolio allocation. Are you loaded up on high-growth tech stocks with no earnings and mountains of debt? Because those are the riskiest assets you can hold when borrowing costs are spiking. Consider shifting toward quality companies with actual profits, strong balance sheets, and pricing power. Third, think about defensive positioning. That doesn't mean cash, because cash loses purchasing power to inflation. But it might mean energy stocks, materials, gold and silver, consumer staples, companies that provide essential goods people buy regardless of economic conditions. Fourth, understand that this isn't just a Japan problem. It's a global deleveraging event. When leverage unwinds, volatility spikes. And when volatility spikes, weak hands get shaken out. The investors who survive are the ones who weren't over-leveraged and who maintained dry powder to buy assets when they go on sale. And here's the thing that nobody wants to talk about. The United States has its own debt problem. We're running trillion-dollar deficits every year. We depend on foreign countries buying our bonds to finance that spending. If Japan stops buying and Europe stops buying, who's left? The Federal Reserve could step in and buy treasuries, but that's just money printing, which fuels inflation, which forces rates even higher, which makes the debt problem worse. It's a doom loop with no easy exit. Japan just showed us what happens when a country with massive debt tries to normalize interest rates after decades of financial repression. The bond market revolts, yields spike, asset prices crash, and policymakers scramble to say calming things while having no actual solutions. Now imagine that happening in the United States. Imagine US Treasury yields spiking, not because the economy is strong, but because foreign creditors are dumping our debt. Imagine the stock market falling, not because of a recession, but because the hedge funds that levered up on cheap borrowing are being forced to sell everything to cover losses. That's not some distant theoretical risk. That's the risk we're facing right now in 2026. And most investors are completely unprepared because they've been conditioned to believe that central banks will always step in and save the day. But Japan's central bank can't save their bond market. The US Treasury Secretary can't do anything except hope Japan says nice things. And the Federal Reserve is constrained because if they cut rates too much, they risk the dollar collapsing, which would make our import costs explode and reignite inflation. So where does that leave you? It means you need to be smarter than the average investor. You need to understand that the game just changed, and you need to position your portfolio for a world where asset prices don't just go up in a straight line forever. The investors who make money over the next few years won't be the ones who bought the hottest growth stock or the latest crypto. They'll be the ones who understood the macro environment, who protected their downside, and who had the courage to be positioned differently than the crowd. Japan's economic bomb didn't just go off. It's still exploding. The shockwaves are rippling through every market on Earth. And the investors who recognize what's happening right now are the ones who'll come out the other side with their wealth intact. If you found this breakdown valuable, make sure you're staying informed as this situation develops. Markets are moving fast, narratives are shifting, and the next few months could determine your financial future for the next decade. The choice is yours. You can ignore what's happening and hope everything works out, or you can open your eyes, understand the risks, and position yourself accordingly. Remember this: in every market crisis, the real disaster isn't the event itself. It's the investors who see it coming, understand what it means, and still do nothing. Don't be that investor. Watch another video here to stay ahead of what's coming next.